Skew. SKEW, it's kind of a weird word. This is such an important topic that so many option traders overlook. And to be honest, when I first learned about skew, I didn't really give it the attention it deserved until I was convinced and able to really see how when skew gets way out of line, it's often the top, it's often the bottom of very, very big, like systematic moves. So super excited to get into skew in front of you. I got you on the whiteboard. And for this example, we're going to talk about a stock priced at $30. So a $30 stock, I do the at the money. We do the calls here and the puts on this side. And so let's say those 30 strike at the money calls are $2. We also have those 30 strike at the money puts at $2. So all I did is, let's say we're looking $10 higher or 10 points higher at that 40 strike. And let's also look $10 lower at that $20 strike. So what the skew is if these $40 strike options were priced at, say, $1, but the $20 puts were priced at 20 cents. That's a big difference. If the stock's at $30, $10 higher or $10 lower, it seems like it's a 50-50 bet. Who knows where the stock's gonna go, right? But that's not always the case. And with options, we have the ability to see what are traders betting on. In this example, there's a higher probability of that stock going higher than the stock going lower. Now, why? Well, this options example is heavily skewed to the upside. So traders are betting almost 5 times, right? $1 or 4 times compared to just 20 cents. 4 times, not 5 times, compared to 20 cents. That's a big, big skew betting that the market goes higher or betting that this option change goes higher. But if we do the same example, and let's say that $40 strike, maybe they're priced at 20 cents, and those puts are priced at $1. Well, right now, this stock or this option is priced to go down because there's more premium on that downside. There's bigger bets making a play that that stock goes down. So it's not really 50-50 whether it moves $10 higher or $10 lower. This stock is skewed to go down. You'll notice, and we're going to go through lots of examples, but you'll notice that every asset class, every stock, every industry has their own specific skew. For instance, biotechs. Now, I'm guessing either you or your buddies, you've heard stories about folks buying upside calls in biotechs. The stock gets approved from the FDA in what's known as their PDUFA date. And that biotech goes from $20 to $200, and somebody makes a whole bunch of money on those long calls. Once in a while, they don't get approved, stock gets cut in half, or stock loses 90% of its value. It's a very binary outcome when you're trading biotechs, especially those that are dependent on the PDUFA dates. Biotechs routinely trade with upside skew. And that upside skew is when those calls are way, way more expensive than those puts. Because that's just showing that the street or that specific options tree is making a bet of the stock trading much higher. It's skewed to trade higher. When those puts are more expensive than the calls, it's really skewed to go lower. That's downside skew versus upside skew. That's biotechs. The other industries that sometimes trade with a higher upside skew, once in a while you'll see the energy complex, specifically heating oil, natural gas, crude oil. Once in a while, those will definitely trade with an upside skew. But let's forget about biotechs and let's talk about that downside skew. And so for the downside skew, I want you to think of like the SPX, the QQQs, the NASDAQ, the broad indices, okay? So we'll just look at, say, QQQs as an example. QQQ, how is that skewed? Well, I want you to put what we call your common sense hat on for this. Because what are the two most popular option strategies that are used by all traders? The first one is going to be buy downside puts. People use options for protection. So if you want to insure your account, if you want to protect your account, it's really easy just to go, hey, I'm going to buy some downside puts to protect myself from a big move down. So retail trading loves to buy downside puts. The second most popular option strategy used is the covered call. What's a covered call? Well, when you buy stock, or if you're a long stock, you could sell upside options to take in income. You can sell those upside options to lower the cost basis of your long stock. So without a doubt, these are the two most popular option strategies. So if you think about that, again, common sense, folks like to buy these puts, buy puts. Also, folks like to sell upside calls, sell. So what naturally happens is the upside calls in the market get cheap while the downside puts get more expensive. And it's like that because of the two most popular option strategies that are used, buying downside puts and selling upside calls, forcing more premium in those downside puts. And I wanted to go through 5 different examples just so you guys can get a feel for skew so we can go over it together. And then after that, we're going to look for trade opportunities using some of the tools that the Chicago Mercantile Exchange offers for free. But first, we need to have that understanding of skew. So AUPH, I took us out to April, 96 days. So the at the money is going to be the 9. The 9 strike. Right now, from this screenshot, stock's at 911. You see the calls about 225 mid-market. The puts, 207 last trade. A little bit more on the calls because they have an extra 11 cents of premium, right? The stock's not trading at 9, it's trading at 911. So whenever you're looking at skew, whenever you're looking at an options chain, I always want to symmetrically go, say, $5 higher. That would take us to the 14 strike. And $5 lower, that would take us to the 5 strike. What a big difference in options pricing. The 5s, you could buy for 40 cents. But if you wanted to bet on the upside, if you wanted to bet on AUPH getting approved at their next PDUFA in April expiration, well, in order to get long those, it's going to cost you $139 versus getting short costs $40, $5 lower. So as you can see, an example of a biotech with a heavy skew towards the upside. Even just buying the stock, there's a higher probability for that stock to go higher than lower just because of the skew. Now, you wouldn't want to buy the stock because it's going to be very volatile. As you can see, there's premium down here. The implied vols are very expensive, but overall, this is skew to go higher. Cassava Sciences, Sava. Sava, last trade 34. The at the money, since they don't have a 34 strike, is going to be 35. If this stock was trading at 32.50, the at the money would be the 35 calls and the 30 puts. That's just what we call the at the money strangle. But let's use 35. And again, we want to symmetrically move 15 higher and then 15 lower. So 15 higher is going to take us to the 50s, 550. 15 lower is going to take us to the 20s, 340. 340, 550. The skew is almost double on the upside. So the options market is certainly not pricing in a 50% chance of going higher and a 50% chance going lower. The options market is pricing in a higher probability of this name trading higher. Again, a biotech example. Biotechs are most often skewed to the upside. The next example is going to be in a silver miner. And after this video, the next video, we're going to talk quite a bit about the skew in metals. So I wanted to introduce a metals miner here, Pan America Silver, PAS. Last trade 1880. So what do we go? 19s. If it was trading at 1850, we could always use those 19 calls and those 18 puts. But if we're just using the 19s, you can see they're priced right about the same price. Let's go $5 higher. $5 higher would take us on that 24 strike, 40 cents mid-market. And if we went $5 lower, that would take us to the 14s, 25 cents mid-market. So right now, PAS, and then I would assume silver as well. But right now, PAS is skewed to go higher. PAS has a skew towards the calls as opposed to a skew towards the puts. Qs. Qs, overall market. 280, 97, we can use the 281 strike. 281 strike, if we look $10, it's trading $9.50. But if we go $10 lower, it's trading $9.10. So they're kind of symmetrical. But what's important for the Qs, guys, is look at the implied vol. Notice how that implied vol is juicier or higher than that implied vol on the call side. We know why that is. We know why that is, right? Because the public likes to buy puts. The public likes to buy puts for protection. It's still kind of symmetrical, but it does feel with these implied going higher, there's there's more premium being added to the put side than the call side. But again, in broad-based markets, we are going to have those more expensive puts because people like to buy downside puts. Folks like to sell upside calls in that covered call strategy. One more example, NMM. Last trade 25.83. We could use the 25 strike, $5 wide strike, so it's kind of tough to get a $26 strike, but let's do $25 strike. The 35s, mid-market 70 cents, and 15, there's like nothing there. Another one, skew to the upside. For whatever reason, we are seeing heavy skew towards that upside right now. A little bit more implied vol going down than up, but overall, folks are betting on NMM with a much higher probability of going higher than trading lower. Notice that 30 strike compared to the 20 strike. That's a significant difference. Folks are bullish NMM.